The capitalization rate in real estate investing. What is it and how could we use it? In this video, we'll go over the cap rate and its formula, an example of how to get to the cap rate, and some things to consider when using the capitalization rate in real estate investing. So let's get right into it. The cap rate, or as well known as the capitalization rate, is just the rate of return a property will generate on an annual basis. So basically the money that you put into a property, what percentage of that will the property be generating in cash? The uses for the cap rate, it basically just helps an investor determine an appropriate price for a property when buying or selling the investment property. And the computation is fairly simple. It's just taking the net operating income and dividing it by the purchase price. And we'll go over an example right now to illustrate how that formula works and how do you get to the capitalization rate. So let's say you're interested in buying a $220,000 building. And this building comes with 4 units. Let's say it comes with 2 smaller units of a bed and a bath and 2 larger units of 2 bedrooms and 2 bathrooms. And let's say for these smaller units, you can get, $700 in rent. And for the bigger units, you can get $950 in rent. This is each month. So to get the rent for the smaller units, we'll just do the rent times the number of units. That gives us $1,400 that we can make off these 2 units each month. And the same idea for the bigger units. It will be $950 times 2, $1,900. Now that's our monthly rental income. Now we want to go ahead and take the sum of these 2 numbers and times 12 to get the annual rental income that we'll receive. So for this number, we want to go ahead and adjust it for vacancy and credit loss. Vacancy is basically just the time in which one of your tenants leaves the property and you're in the process of getting a new tenant, getting the room filled, and between that time frame there's always a few days or could even be a month or so that you have no income for that time because your tenant left and you're in the process of getting a new tenant. For the vacancy rate, we'll just put 2% of the rental income, and to calculate that we'll do the rental income times the 2%. That'll give us $972. And the credit loss is similar to vacancy, saying that the tenant is leaving your unit and didn't pay you the last rent or whatever the case may be. Let's go ahead and put that at 1%. So we'll go ahead and multiply that by the rental income. That will give us $396 for credit loss. And when we add these 3 together, the vacancy, the credit loss, and the rental income, we come at the gross rent. So this is the gross amount of rent that your property is generating. Now, this is just your income. We need to now take account for the expenses. So for the expenses, there's a whole list of expenses that you could possibly have with each property, and it will be different for each property. But we're just going to take a look at 4 simple examples that most investment properties will have. So for the management expense, it's typically a percentage of the rental income being produced by the property. So let's give this a 7% management fee. And to get the expense for this fee, we multiply the rental income being produced, not the gross rent, but the rental income, and we multiply that by the percentage. That gives us the management expense. For insurance on the property, property taxes, and the monthly repairs and maintenance, we typically use a percentage of the market price. So for the insurance, it's usually about 1 to 2% of the market price. Let's give it 1.2. Same for the property. Let's give it 1.5%. And for repairs, let's give it 4%. And again, this is just going to be the market price times the percentage. And I'm going to go ahead and drag this down to get the total expenses for the property. Now for the net operating income, we're just going to take the gross rents minus the expenses for the property. And that gives us just under $21,000 in net operating income. And if you remember from the beginning, that is the first part of the cap rate formula. Now, a quick note I want to mention, the net operating income does not include depreciation on the property, mortgage or interest payments, any financial expenses, and major repairs. So for the major repairs, we could have a reserve account, basically a percentage of the market price that you'll not necessarily expense each month or even each year, but is money that you set aside for major repairs like replacing the roof or any major improvements down the line. So we could use 1% for this, and that'll be the market price times the 1%. So we're basically generating just under $21,000 for this property, and the capital reserve being 1% is around $2,200. Again, this expense is not going to happen every month or even every year, but it's money that you set aside for major repairs. Now we want to go ahead and subtract that reserve account from the net operating income. So that will give us a net operating income after capital expenditure reserves of $18,700. Now we can go ahead and take a look at the formula to get the cap rate. So the net operating income, we determined it was just under 21K. The market price was $220,000. And for the cap rate, again, if we look in the beginning, it's just the net operating income divided by the purchase price. So we take the net operating income divided by the purchase price, and that gives us a 9.50 cap rate on this property. So basically the return on this property is 9.5%. However, if you want to take the cap rate after accounting for your reserve account, you can just take the cap rate minus whatever percentage you have as your reserve. So this property effectively has an 8.5 cap rate. Now, is this a good value? Is this a property worth investing in? Well, that determines on the desired cap rate for yourself. So let's say you wanted a 12% cap rate. We know that the net operating income is just under 21K. If we go ahead and take the net operating income and divide it by our desired cap rate, that gives us the investment value, or basically the value of the property that's worth for you to be able to make the purchase. So in this case, this property is overvalued according to your estimates, and we can go ahead and put the market price minus your investment value. And if it's positive, you have a $45,000 overvalued property in your opinion or in your evaluation. So that's basically the cap rate in a nutshell. It's very useful for determining the valuation on a real estate property, but there are some things to consider that I kind of want to just highlight real quick. The rental income, the operating income used to determine the cap rate, if that rental income was recently increased by the seller over the last few months, the cap rate will look more appealing, because if you increase the rent or the net operating income, you'll have a higher cap rate. But if that rent was increased not too long ago, maybe some of the tenants are shopping around, they're looking for a new place, and what could end up is you buy the property thinking you'll be receiving these rents, and then you have your tenants leaving. So always check the rent over the past 5 to 10 years, as long as you possibly can when valuing a property. Another thing that the cap rate doesn't consider is the management. Sometimes a property can have a low cap rate, but that could be due to management's poor management of the property. For example, they might not be negotiating their insurance premiums, or they might be overpaying on management fees or repairs each month, bringing down that net operating income, making that cap rate a little bit lower. And finally, the rental income irregularities. So basically, if the income that the property is producing is not consistent, or it has a lot of variations, you might want to have the cap rate aside and use a full discounted cash flow to analyze the property. So that's basically the cap rate in a nutshell. Hope the video helps, and hope you learned a lot from it. Thanks for watching.